The investment consortium Fortress, who is in talks to buy the supermarket chain Morrisons, has recently raised its bid from £9.5 billion to £9.9 billion. This amounts to an 8% increase from 252 pence per share to 270 pence per share. This surprise bid raise was in response to rumors that the US private equity house Clayton, Dubilier Rice was preparing equity and debt financing so as to launch a counterbid. If you want to know more about the background of this bidding rivalry, please feel free to see our other videos on the subject. However, in brief, Clayton, Dubilier Rice made an unsolicited bid to buy the grocer, which Morrisons promptly rejected. This led to Morrisons' share price skyrocketing, and then to an investment consortium led by the Fortress Investment Group making an offer which this time was backed by the Morrisons board. The board is due to vote on whether to accept the Fortress offer formally on the 16th of August. However, under UK takeover rules, CD&R has until the 9th of August, in effect this Monday, to make a counterbid or walk away after its initial bid was rejected. This now comes to why Fortress decided to ambush the US private equity house with a last-minute bid raise. A counterbid would have the effect of resetting the deal timetable under UK takeover rules, giving more time to CD&R and prolonging the bidding war. With just over 2 days on the bidding clock left, this tactical last-minute bid raise gives CD&R less time to react. The very announcement of an offer binds a bidder to proceed, so this places pressure on CD&R on whether it wants to commit. It will have to decide whether it is worth making a better offer than Fortress's 270 pence per share. The bid raise also places logistical hurdles on CD&R. For example, any bid made by CD&R must comply with UK takeover rules, such as ensuring it can fulfill any cash consideration. Fortress has raised the bar by £400 million, so CD&R may struggle to find more financing to beat this offer in such a short span of time. However, Fortress's bid raise is also directed towards the Morrisons board. Since its announcement, the Fortress bid has provoked opposition from long-term shareholders of the publicly traded supermarket chain. These include Silchester, Legal & General Investment Management, Joe Hambro, and recently M&G Investments. Combined, these investors represent roughly 20% of Morrisons' share capital, with the Silchester being the largest stake of 15%. Fortress's bid needs a 75% shareholder approval to go through, so on paper, a 20% overall stake should not threaten their bid. But in practice, especially because Morrisons is a publicly traded company, investor turnout can be as low as 60%. Even if the turnout is higher, the opposing shareholders may have more than enough voting power to block a Fortress deal. But this is where the shareholder-specific criticisms against the Fortress bid become relevant. Some are less direct than others, but in the end it all boils down to a higher price. M&G has said that Fortress's previous 252 pence per share offer did not reflect the true value of the company. Joe Hambro has also said that any offer for the group approaching 270 pence per share merits engagement and consideration. Therefore, Fortress's renewed 270 pence per share offer may swing some of these shareholders in its favor. But there are still some holdouts which are likely to stay. Most significantly, Silchester, the largest opposition shareholder, has said that the Fortress deal structure constricts the Morrisons board to a short timetable, which does not give opportunity for competing bids to emerge. Opposition from Silchester is particularly significant because depending on voter turnout, it may have the ability to single-handedly block the Fortress bid with its 15% stake. Therefore, the Fortress bid may be resisted purely on the basis that there may be other more competitive bids out there. So what does the future hold for the Morrisons saga? Shortly after Fortress announced its bid increase, Morrisons shares shot up from 270 pence per share to 278 pence per share, where they still hold steady. Therefore, it may still be in CD&R's interest to commit to a counterbid. But as the tactics of other potential counterbidders show, this may not be a good idea. For example, private equity house Apollo recently dropped its own plans for a counterbid, and instead is in talks to join Fortress's consortium for Morrisons. Singapore's sovereign wealth fund, GIC, also recently joined the consortium. This raises its capital pool to rival any potential counterbidders. Overall, this makes Fortress's consortium a formidable opponent, and rival counterbidders may not be inclined to enter into a long and expensive bidding war. This is especially true for CD&R, who will face regulatory scrutiny from the Competition's Market Authority if they make a successful bid to Morrisons. This is because of the overlap of Morrisons petrol stations and those operated by the Motor and Fuel Group, which CD&R already owns. We should also take into consideration the possibility of political scrutiny of a Morrisons deal with any foreign entity. Morrisons' unique business model means that they manufacture 25% of their own fresh food. Their role as a food manufacturer, in addition to a staple British retailer, means that ministers have sought assurances that a privatization of the supermarket chain would not affect British jobs or supply chains. With the CD&R deadline due on the 9th of August, and the outcome of the Morrisons board vote on the 16th, it is worth following this situation closely. As always, thank you for watching the video. Do consider leaving us a like, comment, and subscribing for more great content.